before we get started, we're Elevate Commercial Investment Group. A lot of you guys, if you're on this webinar, you probably know us. We buy multifamily apartments across the country. We've been doing that for 7 years now. Nick, who is on the call joining me, he is our senior acquisitions director and senior underwriter. He leads the acquisitions front and underwriting our deals once before we purchase them and afterwards too. So Nick was a great part of our addition to our team last year. Also on the call, Mina, who you may have talked to if you're on this webinar about your investing goals, your investing strategies, what you're looking to diversify in multifamily. So if you're an investor of ours or a prospective investor, you probably talked to Mina as well. He was another great addition to the Elevate team last year. So today you've signed up for the underwriting multifamily acquisitions webinar. So all educational on how we look at deals, how specifically Nick looks at deals. And we'll also include a case study of one we actually underwrote and closed on and have been operating for about a year now. So I'll hand it over to Nick to get us started.
All right. Thanks, Brian. Thanks everyone for joining. Yeah, we're going to talk about underwriting multifamily acquisitions and do a case study today. It's going to be pretty open format. So again, feel free to ask questions in the chat and we'll get those answered as they kind of come in. But yeah, let's go ahead and get started here. So I guess chapter 1, Brian, you can see my screen, right?
Yep, got it.
Gotcha. Yeah, so chapter 1, what makes a successful acquisition? We don't want to be buying deals that aren't successful. So what kind of ticks our boxes here? So really, we kind of break it down into 3 criteria. 1 is finding motivated sellers, 2, developing realistic business plans, and communicating early with your property manager, and budgeting properly, and then structuring the deal to avoid being a motivated or forced seller on the back end. So we'll dive into each of these 3 points here. So finding motivation and finding motivated sellers. Why does the owner want to sell? This is really one of the most important questions I like asking brokers and figuring out what the motivation is day one. It's just easier to understand, especially in an environment right now where there's a lot of uncertainty with interest rates. Treasuries are going back up, inflation's coming down, stuff's kind of all over the place. So it's not a great time to sell if you're an owner. So figuring out why groups are selling right now, it's really important. Whether, a developer is just looking to exit, they've built their project and they just want to exit and move on to the next one. Maybe it's a fund that is ending and they need to sell the property. Maybe there's an upcoming loan maturity. Maybe the owner's just retiring and he's ready to move on and sell the asset. Maybe there's a disagreement within the partnership. There's kind of a plethora of reasons that an owner would want to sell, and really getting to the bottom of it's pretty important, because then you can structure your offer a certain way and lean into certain things. So where to find deals, there's pros and cons to some of these, but on market, there's typically a larger buyer pool to marketed or brokered deals. There's some great deals in the on market space, and we're definitely looking at a lot of them right now and offering on a lot of them. Off market, there's a smaller buyer pool. This is more of stuff that gets brought directly to us through relationships, or just going directly to the owner would be kind of the third path here. I'd say the majority of our deals right now are still on market, although we're trying to source more off market and direct to owner opportunities. And as I mentioned, there's pros and cons to each of these. It's just, having more than one medium of sourcing deals is pretty important, I think.
100%. Yeah. And on market is like a loose term too, like, lightly marketed, sent to their email list, but it's off market. I think there's some gray area there. What defines on market or off market? What would you say defines on market?
Yeah, on market, it's probably going to be with a major brokerage shop. There's going to be an offering memorandum, a full deal room. It's being marketed to the wide range of owners and operators out there. Off market, I would kind of categorize it as maybe there's a more select buyer pool of 10 to 15 groups that the either broker or contact is sending the deal directly to. Maybe it's a group that they've transacted with before and they would just like to make it a nice, clean, quick sale and not have to do a full marketing package and all that. That's kind of how I look at it. All right. So yeah, the second part here in a successful acquisition, developing a realistic business plan. So, there's the challenge in a lot of these acquisitions is developing a realistic, I guess, pro forma or what you really think you can operate the property towards versus what your property manager thinks they can do. Obviously, my role is to acquire new properties and do more deals, versus the operator. They're the ones on the ground, or the property manager. They're the ones actually on the ground that have to stick to a budget. So what's beneficial about Elevate is we have our in-house management. So I'm constantly on the phone with our COO and COO of the property management company. I'm in the weeds on the asset management and the actual operations on these projects and seeing how they're trending and where expenses are going and where rents are going and where lease trade outs are. So a lot of that data and information gets baked into our assumptions on our acquisitions. And I think that gives us a pretty good competitive advantage when looking at deals and markets that we're active in. So this is kind of part two, but I would say this part gets missed by a lot of groups that are probably a bit too aggressive on their acquisition pro forma and saying they're going to probably push income a bit too aggressively versus where it might actually land. And this part's definitely key to making a successful deal work.
Yeah, and like you said, like on the phone with a property man, like that's great. You're doing after, and that even starts before we even buy the project, and what you've helped with a lot too, fine tuning those kind of items with the property man. It's a lot easier when the property management you have ownership in, you can control that, and they're also going to be getting into the weeds with you. Not a third party, they may not get the property, something might not happen, they might not be as incentivized to give you the full picture. They may just want to manage the property, so it's definitely nice having that layer to the deal, and super important no matter what you're doing, getting into the weeds with a property management. I don't know if you were going to talk about that too, but other parties that we're engaging, that might be later in the presentation.
Yeah, that might be a little bit later on, but I mean, really the key question here is how has the property performed historically over the last year and even prior to that, if you can get that data, and then how do we expect that we can perform it differently or improve on that performance? That's really the key question here. We don't typically want to be buying something that is already at peak performance because you're probably going to be paying top dollar for it. Not to say that's not a bad deal, but that's typically going to result in lower returns. But sometimes the deal might make sense in that case. But we typically would like to see some operational efficiencies when we're looking at deals. Maybe they have one too many staff on the property and payroll. Maybe their general and administrative expense is a bit too heavy. Maybe we can cut back on some overhead. Maybe there's some R&M, repair and maintenance line items that really should be below NOI. Maybe some of the contracts could be adjusted, stuff like that. So there's a plethora of ways that we would look to add operational efficiencies on the expense side, and then also on the revenue side. That's a whole nother game. But digging into unit mixes, comps, etc., which we'll talk about in a bit. All right, so part three here is kind of just avoid being a forced seller. So ties back to part one. Don't need to repeat a lot of these, but you just don't want to end up being a forced seller. So it comes down to not overpaying for the property, structuring your capital right, your senior lender if you want to finance it with debt, and also with any preferred equity or second lien positions, making sure that the term of the capital matches the term of the business plan. If it's a short-term business plan, then in some cases it might make sense to bring in bridge debt. But typically we're doing 5-year business plans or 7-year business plans right now, giving us plenty of runway and structuring that with 5-year debt or 7-year debt to avoid being a forced seller.
When does it make sense for a short-term business plan, or does it really?
Yeah, I would say I've looked at a couple deals recently where it might make sense to bring in bridge debt. The challenge with bridge debt is it's still pretty expensive, although it probably will start coming down here soon as it's typically priced off SOFR, and with these rate cuts, that's directly impacting that lower rate there. So I would say if there's a clear path to buying at a low basis, and then the surrounding properties are all stabilized, and you can really just see the vision of bringing the property value to market in a short period of time, whether it's through just increasing occupancy, bringing rents up to market through renovations, or taking maybe there's a lot of down units and the owners ran out of money. So there's got to be a really good story, I think, and the basis has to be very attractive day one to bring in bridge debt right now. And it's really it's a larger bet on where you think we're going to be in 2 to 3 years, depending on what the term of that bridge debt is. And I don't know, real estate to me, it's a longer game than 2 to 3 years. It's probably for some groups, might not be for us though on every deal, but we're still looking at some of them. All right, so I'm gonna keep going here. The chapter 2, high level underwriting. So I mean, we're looking at a lot of deals each week, and I think having a quick acquisition funnel and knowing what makes sense right off the bat and what doesn't make sense is pretty important. Let's see. So I mean, the goal, I guess, with high level underwriting is kind of just taking a back of the napkin approach. This stuff is not rocket science by any means. Essentially, just I really just need 2 data points to understand if I want to chase a deal or not. I just need to know, what the asking price is, or where's pricing guidance, what's that range, and what are either the average in place rents or what are the market rents. And with kind of those 2 data points, I could probably tell you if it's going to be a deal worth chasing or not. And obviously the vintage, location, demographics can come into play there, but those 2 data points, I mean, you can essentially get down to a stabilized NOI pretty quickly with that if you know your tax and insurance and expense numbers pretty well. But I'd say the goal with high level underwriting is to weed out deals that are not worth chasing and really funnel in deals that are probably going to make sense chasing. So there's a lot of deals out there. Again, we're looking at a bunch each week, and only a few of those make it into the actual next stage. So let's see here. I don't think we need to touch on too many of these questions, but this is really just kind of a mindset that I like to keep when looking at deals.
What were the data points again? You said 2 data points?
Yeah, I mean, purchase price or pricing guidance and rents. Either average in place rents at the property if it's already stabilized, or market rents. That's essentially it. If the asking price is 190 per unit for like a 2000 build asset and their rents today are $1,200, that deal's not gonna work right off the bat. I'd probably, I mean, depending on the location and where we can push rents, probably just pencil that closer to like 145 a door, maybe, just as a starting point. So there's a lot of like back and forth where, we'll get deals and immediately it just doesn't make sense to chase it just on pricing guidance and where rents are. Um, but
Yeah, it goes into Donnie's question about how do you funnel out the deals quickly? So exactly that, looking at the pricing guidance and um, comparing that to the rents is a quick way to look at that.
yeah, and I would just kind of clarify a bit more. Looking at stabilized rents. So I mean, if the property is for whatever reason not performing and the rents are low, and you really truly believe that either a comparable property or it is really the ideal rent profile for your property, then yeah, maybe a stabilized yield on cost instead of a going in cap rate makes more sense. But really, the price and the rents is just kind of the first funnel I take, and then deals can get more complicated with capex and stuff like that, and your total basis and where your NOI is going to stabilize. But I would say just the starting point is price and rents.
Someone asked, now I don't know if this is on a later slide too. 7 of 30. Can you talk more detail on all cash versus does it only work with debt?
Oh, yeah. So I guess the mindset there is, um, are we financially engineering the deal? Or if we bought it all cash, meaning like just our cap rate, but what does the deal look like? Debt is just an instrument to bring in cheaper capital typically than equity. So are you solving to an IRR and financially engineering the deal, or does it work simply as just an all cash deal? And would you park your money there instead of a T-bill or something like that?
Great.
Let's see. I kind of touched on this briefly. This example, I mean, this one, 190 a door. Let's see, it's an out-of-state owner, doesn't operate any assets nearby. You can stabilize rents around 1,700, 1,750, $1.97. I would chase that deal all day, assuming it's a good location, a market that we want to be in. The spread between the chunk rent and the asking price per unit and per square foot, I say that makes sense right off the bat. So you can probably justify a price here that makes sense. Let's see, this is kind of high level underwriting example. Brian, can you see my screen or is it too small?
I can see it. Yeah. Rent a unit 1650.
Gotcha. Okay. I
Yeah.
didn't want, I just want to make sure it wasn't too small and I was just speaking out of line here. But okay, so this is really just a high level underwriting snapshot. I want to focus on the left side of the screen here. This is just a quick little template anyone can put together, but this column right here is just our T12, trailing 12 NOI, trailing 12 performance, just the last 12 months of performance. How's the property performed? This is, this would be a marketed deal. The broker's providing us their guidance on NOI. And this column would be, where do I think, or where do we think the stabilized NOI is going to be, based on our market information, based on what we're seeing, et cetera. So in this example, the trailing 12 NOI, let's see, it's roughly at $1.9 million. And at pricing guidance of $38 million, it's a 5 cap. Broker stabilized NOI. Looks like they dropped economic loss by dropping vacancy a bit. they pushed other income, and they adjusted some operating expenses. You know, brokers saying you can stabilize closer to 2.4 million of NOI, and that would be a stabilized 6.26 cap rate. I would probably underwrite up, depending on, again, the market, if there's a lot of supply or not a lot of supply, future supply and all that. In this example, I'd probably underwrite a less conservative, or sorry, more conservative vacancy loss here than the broker. So my economic loss is a bit higher. I'd probably drop rents a little bit more depending on what I'm seeing with comps and what the average in place rents are. I probably would adjust OpEx a little bit higher. I'm getting probably to a 5.9 cap day one, and then ballpark CapEx numbers, ballpark closing costs, fees, working capital, contingencies, etc. Let's see, this might be a bit high actually, but this would get down to our total basis here, and then you'd be looking at a yield on cost, and then really, the whole play with real estate is you want your yield on cost to be higher than your exit cap. Anywhere from, I'd say, 150 bips to 200 bips is probably strike range. So in this example, if I think we're at a 5.43 stabilized yield on cost, I'm not going to be able to pay full purchase price here, because I doubt our cap rate in this market is going to be 200 bips lower. I mean, that would be a 3.43 cap rate. So I would simply either adjust my assumptions here or adjust price to solve for that healthy spread between yield on cost and exit cap. Touching briefly on exit cap, I'm going to underwrite each deal with a range of exit caps. I'm not going to plug in one exit cap and just call it a day. We're going to stress test our deals with a range of exit caps, and you kind of weigh that exit scenario in your head on the price per unit, price per net rentable square foot, and see how it feels. And I'd say really the most important thing though is the deal cash flowing? Or are you simply just betting on a sale to hit your IRR or your equity multiple? I'd say similar to any company that's paying a dividend, a property that's able to produce a cash distribution is very important. It's showing that it's a healthy property. You didn't pay too much for it, and it's servicing its debt properly. So that definitely plays into it. We're not just looking at exits. We definitely want to factor in cash flow as well. So yeah, I would essentially, just follow up with the broker here and just say if they're flexible on price at all, if they're able to come off that 38 million with any sort of other terms that they'd be able to work with us on here, like hard money, would that help with a price reduction? Maybe there's some assumable debt on the property, and if so, we would definitely want to understand that. Maybe they're open to some seller financing as well. Every deal's got a different little twist to it, so just asking more questions and getting more granular from there would really be the goal. All right, we've got some more slides here, more detailed analysis. So we'll talk about T12 analysis, unit mix analysis, future rent growth, rent comps, stabilized future rents, sale comp analysis. All right, T12 or trailing 12-month P&L analysis. So this is to identify historical operating trends, identify either errors in their operating trends or anomalies in their operations. We do this on every underwriting, and it's just a nice little snapshot. It shows you the month-over-month changes in performance. So for this property, it's a total of 386 units. As you can see, net rental income here started at 271, and it's trending all the way up to 375. It looks like vacancy is decreasing each month, so this is probably a partial lease-up deal. They're finishing their lease-up, it looks like. Bad debt looks kind of high, so maybe there's an issue with, actually collecting the rent from these residents. So that might be something that we highlight in our analysis. Economic loss again decreasing over that period, other income increasing, effective gross or total income 308 all the way to 419. So nice little trend here on the total income. Payroll and all these other expenses roll down into total operating expenses. And on this trailing 12 month, I forgot which deal this was, but they didn't include any sort of insurance expense. So, that's just something that we would adjust for. We would probably just say, look, your trailing 12 doesn't include insurance. We're going to throw in our pro forma or next year's insurance back into your trailing 12. And, that's going to be essentially the new adjusted trailing 12 financials. But yeah, I mean, this is just essentially a quick way to look at trends and income and expenses, and also catch any sort of errors or anomalies within the historical
How are
financials.
you under? I had a good question. A lot of questions coming through. Keep these up. Mina is answering some of these in the chat, and I'll pick some of these. And Jim asked, how are you underwriting insurance volatility? What contingencies? Insurance in many Texas markets has doubled and even tripled on some assets in the last 2 years.
Yeah, it's a challenging question. They have doubled and tripled in the past few years. I would say right now we're seeing a few either flat insurance renewals or decreases in renewals. Every single one is going to be a property by property case. So it's really a difficult question to answer. I would say it largely depends on location. A lot of the Midwest properties have very low insurance premiums still. A lot of the stuff like you're seeing in Texas, C-class stuff or stuff along the coast, and Florida obviously has very high insurance premiums right now. So we typically want to stay away from deals where there's excessive insurance risk. Like you mentioned, we looked at a couple deals along the coast, and ultimately we just passed on them because like you're saying, the future insurance is almost impossible to underwrite because you're kind of playing a guessing game there. Although I think we're making some headwinds on some combined or co-partner-esque insurance policies where it's sort of a self-insurance program, and so it's a little bit more consistent, as well as looking at multiple years of policies instead of just a single year policy. Looking at maybe 2 or 3 year policies and paying a little bit higher premium up front to lock it in for more than 1 year. So there's ways to look at it, but really it's a case by case basis. We got any more questions we want to answer now, or?
Yeah, well, actually, he had, so a couple questions. What cap rate, you said you look at several exit caps. What cap rate are your numbers based on? What is your standard practice on exit cap the last 6 months?
Yeah, it's a great question. I would say for C-class deals, meaning probably 1980s or 1980s or older vintage in a probably lower tier demographic area. We're underwriting 6.25 to 6.5 exit caps. So obviously that means you need to stabilize north of an eight yield on cost, and your stabilized cap rate needs to be even higher, which is definitely very challenging right now. It's just not really something that I think is worth betting on unless your going in basis is just that attractive. So I'd say for Class A deals, there's probably going to be a shift towards more cap rate compression if I had to guess. I kind of have seen them cap out or top out around the 5.5 for true Class A market rate deals in good locations. A stabilized and trying to stabilize around a 6 or 6.25 cap rate on those deals is really the goal. And then exiting around either a 5.25 or a 5 is probably what I would plug in.
Yeah, so it's hard to, hard to have a rule of thumb. We actually looked at a C-class deal in Texas that we were pretty close to a 9 cap, that we weren't didn't move forward with. That was a very old vintage. And then we're also very excited about one we have under contract that is a 2023 vintage for what's a cap rate on that?
Yeah, we
Uh,
have the exit cap at a 6 on that one.
but going in cap.
Yeah, the going in cap will be around a 7 or 7.1.
Yeah. Yeah, so a 7-1 cap we're really excited about. A different asset, 9 cap, uh, we were very cautious on just because of the age. Old, so for a certain number, almost any deal makes sense. But would you say market or vintage has more effect on cap rate?
I'd say market for sure.
Yeah.
Um, there's class A deals in very tertiary markets that still carry high cap rates. Um, versus, maybe a class B or B plus deal in a prime market is going to be a pretty low or aggressive cap rate.
And I remember looking at some of those old deals in like North Dallas. It was crazy. Those forecast, they were 1970. I mean, they were remodeled, but 1960s, 1970s, and just going for crazy low cap rates right there in Plano. It's
Mhm.
yeah, it's a good point.
Yeah.
And then there was another question on the last deal, so we're actually going to go in on a case study of one of those two.
All right. So I'll just keep going here and then we can take another break for questions in a minute. But unit mix analysis. This is simply just a breakdown of the unit mix of the property. So in this example, there's 276 total units of this property. The average square foot is 1124. Occupancy across the unit mix is 93%. Average rents are 16.13 or $1.44 square foot. Max in place rents or the highest rents achieved for each unit type are 1849. And that's achieved across 12 units. And then I like having this compared to our year one underwritten rents and how many units have actually achieved those underwritten rents already. So this is simply just a snapshot. And also on a lot of deals, there's going to be renovated versus classic units. They typically tag these in their rent roll with an R. So you'll see in this example, the R versus the classic 842 square foot unit. Both of them are 100% occupied, but there's a nice premium on the average in place and the classic versus the renovated. So there's roughly 150, 160 bucks difference in rents here. So that's a nice renovation premium. And there's probably a little bit more juice to squeeze on this one if we wanted to invest some CapEx into these classic units. All right. Future rent growth. This is also a pretty hot topic, similar to exit caps. If rents are growing in the future, then you're essentially just stuck at your purchase cap rate, assuming expenses don't change either. You want to expand your cap rate and your margin on the deal. So you want to buy in markets where there's going to be future rent growth. Well, how do you know there's going to be future rent growth? Well, it's essentially, supply and demand. If there's a large amount of supply, meaning new apartments coming in, and there's not a lot of demand from residents or population movement or growth, then you're going to have a rent decreasing environment, which we're kind of going through that a bit in DFW right now because of the large amount of supply that was delivered recently. But over the next 3 to 4 years, all of that supply is going to get swallowed up very quickly, And then future rent growth is going to, in my opinion, hit pretty hard, increase fairly quickly. As a lot of developers right now are not breaking ground on new projects, and there's still very strong population growth in the DFW Metroplex. So again, it's a deal by deal basis on future rent growth. We're gonna weigh it towards median household income in the area and around the property. We're gonna look at historical rent growth. We're gonna look at supply. We're gonna look at, you know, what does the deal pencil at in a base case? What does it pencil at in a more aggressive or more downside case? So it's again a case by case basis, and you really want to be looking at pretty affordable rent to income ratios. So we don't typically like to go above a 30% gross rent to median household income ratio. We want to stay in that low 20s range.
Yeah, median household income, definitely good to be taken into account. Where do you find that information, median household income?
It's available in many different sources. Nova Grodak, HUD published median household income or area median income. CoStar's got it. It's City Data is another website that publishes a lot of this stuff. So there's various sources for this stuff. All right. Rent comps or rent comparables. This is just another piece of the puzzle here. The idea is, you want to know what your competition is. You want to know what their rents are. You want to know what's performing well, what's not performing well. Why is it performing well? Maybe they have a better amenities package. Maybe their units are upgraded and nicer. Maybe they're just simply managing it better. There's a number of reasons why they could be performing better, but having the data in front of you and really, understanding what your comparable properties are in that little pocket. You don't want to be really typically looking at comps outside of a larger range, I'd say, than 5 miles. We like to stick in, what are my locational comps? And then you dig into what are my vintage comps and really my true comps. So, in a lot of ways, location is the winner in all deals. So you want to be looking, what are my locational comps first? And in this example, the subject property, 2021 build, larger floor plans than the rest. The higher rents here are pretty interesting. 94% occupied as well. This almost tells me, like, I would honestly I would probably call up this property right here, this 2017 property, and I'd say, hey, do you want to sell your property? Because I think there's an opportunity to probably push rents higher based on where these chunk rents are and where these per square foot rents are. So, having comparable data and market knowledge is very important. And this is simply just another way to kind of also source acquisition opportunities when looking at comparable rent comps and stuff like that.
Yeah, definitely. You get that added economies of scale there too.
Yep. All right. Sale comps, this is
Well,
helping us.
someone said, just specific to that, we'll get their other questions, but what kind of radiuses are you looking at? 5 miles, 2 miles? You think maybe it might be closer to 2 mile radius?
Yeah, I would say under 2 miles is preferred, but really some markets there's not a lot of product. So, I'd say anything over 5 miles is definitely too far. We don't want to look at comps over 5 miles. I'd say in that 1 to 2 mile range is really the sweet spot. And then anything above 5 miles is probably not really truly a comp. Even if the product type is similar, the location just isn't the same. Sale comps. And what we're going to do here is really just look at what we're purchasing or trying to purchase the property for, and what's our basis or total basis relative to what similar assets have traded for in the market. So I guess in this example, we were looking at a deal. We wanted to buy it for 19.5 million or 187 per unit, 153 per net rentable square foot. Pretty attractive price here on a comparable basis, looking at the weighted average of the comparable properties that have sold. Now, I'd say on the radius here, it's a bit trickier because stuff doesn't trade that frequently these days. There's been quite a dip in capital markets activity and transactions. So we're okay going and looking at a wider range of assets that have traded when looking at sale comps versus rent comps. But really the idea here is understanding where other deals have traded, comparing that on a per unit, per square foot basis, and then also looking at, what are the rents at that, or asking rents of that property, and what are the asking rents at our property, or our underwritten rents, and you typically want to see a higher rent to price here ratio, so a higher percentage ratio here than where stuff has traded. So in this example, we'd be around 12.6 rent to price percentage versus the average was around 8.8. So it's just more data points to get you to build knowledge about the deal and to really drive the thesis home that you're buying a good deal, because basis is by far the most important part of these deals. You don't want to be overpaying. All right, so we got a case study here.
Someone asked, are there any, it made me laugh, are there any deals left? It feels like inventory hasn't really changed on older undeveloped props and a large growth of new props.
The
Any deals
question is,
left?
are there any deals left? Yeah, I'd say there's plenty of deals left. I'd say the prices need to adjust a bit still. We're still offering out a lot of deals. And we've got one under contract right now that I think is a pretty solid deal. But I'd say, the deals are out there. It's just really a matter of finding them and sourcing them and structuring them properly. And a lot of the front end work that goes into these deals is the challenge.
Yeah, I would say that part is key, structuring them properly and sourcing them. It's definitely a lot more front end work than it has in the past.
All right, so for the case study here, this is the deal that we purchased last September 2023. Stony Creek Highlands in Rapid City, South Dakota. So this is on the west side of South Dakota. This was a deal that we had. The deal came from a broker that we had a good relationship with. We've worked with them before. They had not sent it out to a large, it wasn't mass marketed or it wasn't on market. This was more of a off market deal, so not a lot of buyers on the property. We underwrote the price and at 46.7 or 168 per unit. This was 2008 construction, 278 units, 937 average. Key part of the deal was the occupancy. It's averaged over 99% over the past 4 years. And in our view, the owner who also developed the property, they'd been keeping rents artificially low compared to what we thought was true market rent for the area. And we also like this deal simply because the lack of the supply demand imbalance in Rapid City, the population growth there, and the lack of supply that was and future supply that's going to be delivered in that area. And it's also just a really good spot in Rapid City up on a hill, and great demographics. So again, some more reasons that we like the deal. We purchased this I guess have worked with the owner before on another deal which was performing well, so there's good history there. The basis was solid with limited downside for this vintage based on comps. The location is a highly sought after area in South Rapid City submarket, good income levels and very low crime. Very nice property layout with over 27 acres. So very low density of 10 units an acre, which is almost unheard of for garden style development. So it's a very spread out feeling. It's almost like you're at a mountain retreat or something up there. It doesn't feel like a very crammed apartment complex, which is nice. The large unit floor plans are nice as well. So the income when we were looking to purchase it, it was trending very in the right direction. It was increasing. The T1 income cap rate was a 6.3, and the T12 income cap rate was a 5.6. So they were implementing essentially rent bumps on a portion of their units and saw some nice growth in their income over the last 12 months. And we were essentially just going to replicate that over the rest of the unit mix. Off-market deal, already touched on that. There wasn't going to be a bidding war with 50 different offers. The seller was also the original developer. It had owned it for over a decade, and this was the last asset they'd owned in the submarket. So really just plethora of reasons why this deal was attractive from day one. Deal economics, already touched on this a bit. T12 cap rate of 5.6, T1, T12 cap rate 6.3, strictly because this change in income over the last 12 months, it was increasing with the rent bumps that they were getting. Pro forma year one cap rate was a 6.2 with adjusted insurance and taxes, a little bit higher payroll and contract services, etc. Year four cap rate 7.1, and our exit cap here was around a 5.75, and our year four stabilized yield on cost was a 6.5. So this was a 7-year hold period. So we wanted a little bit more. We wanted a little bit more cushion on our yield on cost versus exit cap. So this was structured as a longer hold period specifically for that reason, versus a 5-year. We didn't think that a 5-year is going to give us enough time or window to actually hit the future rent growth that we're going to need to make this a successful transaction.
Yeah, and we got some great debt on that 7-year term. Got even a little bit better debt for the 7 years, for holding it for 7 years, and the market being, quote unquote smaller than other markets, that helps too.
Yep. This just touches a bit on the demographics in the area, but essentially, we did our research in the area. Median household income around $77,000. It's been increasing each year for the past 10 years. Strong employee background, strong job growth, low unemployment around 2%. Kind of a quiet, untapped market in our opinion, where it's just really good fundamentals, low supply, high demand, and it's just an appetite for really strong future rent growth. Let's see, a lot of text here. The business plan included a light value add business plan, so nothing heavy on the capex that we're going to do. It was a very well kept asset, as the owner had taken really good care of it, and the property was essentially 99% occupied for over 4 years, and they just essentially just hadn't pushed rents that much. So it was a pretty simple execution on the rent growth there, bringing rents up to market and managing expectations, and having the right people at the property is really the key, and having the right management. So really the rest of the business plan was push rents over the next 7 years in the undersupplied Rapid City submarket. By year 7, 2030, exit rents are only $1,853, which is 28.5% of 2022 median household income. And that's going to grow over the next 7 to 8 years as well. So this percentage in the future is going to be probably in the low 20s. But overall, let's see, I guess one other trick that we had on this deal was when we put it under contract, we negotiated some rent control where we would essentially approve the lease renewals or the new leases. So we had some control during that period. 3 or 4 month contract period on where leases were turning over. So that gave us a little bit of an extra boost on this deal, so we could get a head start on our rent growth.
Yeah, and our other deal, we took that a step further and actually have our property management on site. So definitely something to talk about when you're negotiating there.
Yep. These are a snapshot of the sale comps that we are just looking at. So yeah, we're buying it for 168, 6.2 entry cap, 5.75 exit cap. Not a lot of transaction activity up in Rapid City. That's kind of the challenge up there. That's a quieter market, but some of the transactions that occurred, obviously in 2022 was a different year to buy, but those were in the low four cap range. So we added a nice cushion on top of that and called it a day at an exit cap of 5.75. And the deal pencils really well at that exit cap. And if exit caps drop from there, that's great. And if not, and they expand even more, we're still in a really good position and not going to be a forced seller on that one. So I guess in conclusion here, we touched on a lot of this stuff, but motivated seller is important, realistic business plan, good yield, good basis compared to sale comps and replacement costs, good location, and avoid becoming a forced seller is kind of the key criteria that we have when making a successful acquisition. And I guess more of a macro look on this. We're experiencing the peak of supply delivery right now, and transaction volume, especially in DFW, is probably 70 to 80% of a decrease from the peak. So not a lot of transactions are happening. A lot of the units are being delivered in 2024. There's not a lot of groundbreaking happening, and there's a lot of population growth here. So, every market's different, but we think right now it's a buyer's market. There's not a lot of competition on the buyer's end. There's definitely still competition, but there's a bid-ask spread between what sellers want and buyers want. But it feels like a buyer's market, especially compared to what it was in 2021 and 2022. So we're staying active on the acquisition front and looking for deals that check all the criteria that we talked about. All right.
Awesome. Yeah, I appreciate that. It's a lot of good insight. A lot of good questions that came throughout. I put my email and Mina's email. We can send you a copy of this if you want a copy of the slides. And David put in here, third-party property management versus self-management. What do you find favorable for a new deal?
Yeah, I mean, I would give my opinion that I think there's great third-party managers out there. A lot of it comes down to communication and just knowing and having that strong communication and having a point of contact every day and really getting the truth of what's going on at the property levels is really the key. And not letting things go unseen or unfinished for months on end. So yes, while there's good third-party managers out there, I think the preference on our end is definitely in-house or self-manage, simply because the communication's better, and two, we are more honed in on our operations. So there's better alignment with acquisitions and management and operations as well.
Yeah, well, great. Well, 6:59 here. So appreciate everyone tuning in tonight, whether that was on Facebook or signed up on our Zoom webinar. So look forward to continuing to look at deals with you guys and reach out if you have any more questions. All right. Thanks, guys. Thanks, Nick. Thanks, Mina.
Thanks.
Bye.
Yeah.
Bye.